Hello, everyone. Welcome to another installment, our first of 2021 of Meet the VC. And we're going to get started here as everyone starts to get logged in and settled in. So in the meantime, what I would like you to do is introduce yourselves via the chat that we have, and give us your name, your company, a URL, and let's try to use that chat here to simulate the networking that we do at a live event. So we've been doing these now for a few months since we've gone all digital, and our chat has led to people connecting and coming together and doing business together. So let's be active in there, and I'll be there throughout the entire event. My name is Dan Dato. I'm the CMO at Early Growth. My background is as an entrepreneur. I've started and grown half a dozen venture-backed businesses, raised a lot of capital, lost a good chunk of it, had a few that worked out well though. And I'm coming to you today from Santa Monica, California, although I'm an East Coaster and I've been around the world. So again, some ground rules for today's webinar. We're gonna go for about an hour. The Q&A from you guys will be interspersed throughout. So please ask your questions anytime. If you have a question for either our co-moderators or our VC, use the Q&A panel. Let's keep the chat to networking. If you put questions in there, they get hard to filter out, and hopefully that there's a lot of chatter. So again, introduce yourself, let us know who you are, what your name is, what your company is, one sentence about your company, a URL, and where you're dialing in from. Last but not least, this is going to be recorded today. So afterwards, probably tomorrow, we'll send up a follow-up email with a link to the recording, which will be up on YouTube. Many of you know about Early Growth very quickly. We're an accounting firm for high-tech startups. We've been around for a dozen years, and we provide the entire finance stack so that you can focus on your own business, focus on your customers, focus on your team, focus on your product. And we take care of those nuts and bolts, whether it's the day-to-day finance and accounting, the monthly financial reporting, the strategic financial planning and strategy that you might do with your board, or the annual things that you have to do with taxes. We're there, that we can help with all of it. Some of you might know this, although we haven't made a big deal of it. We have merged with Escalon Services. Escalon is another company that in profile looks very, very much like us, around more than a dozen years, and gives us a lot more resources, expertise, a global footprint. So the end result of it is we can help more people with more things than we ever could in the past. We do these events not on our own, but with a great team of partners. Just as you're building your startup requires you to put together an amazing team, doing anything of significance, and a webinar like this is no small effort. It takes a team to put together. So for today, we've got a few partners here, and bear with me. I'm going to stop sharing my screen. I'm going to say hello, and I am going to invite each of our partners to come on here. And first one is Pete McDonald with PacWest Bank. So Pete, I'm elevating you to a panelist. Your video should turn on, your mute should go off, and please come in here and tell the folks in a quick 30 seconds or so about yourself and PacWest. You're on mute, Pete, but I see you there.
There we go. Is that better?
That's better. I can't see you. If you can turn your video on if you want.
There we go. Now I'm on my third headset. So Pete McDonald with PacWest. I'm SVP of our startup services team for the East Coast. I don't know if Mark DiTargini's on, but he is my colleague on the West Coast. And we are a venture bank. We engage with early stage companies through our Square Roots program. which is kind of a free checking perks platform and community building activities. And with the idea that these companies will grow into debt, treasury management, all those types of things. So try to really work with the early stage companies as they're really starting their journey.
Awesome. Pete, thanks to you, to Mark, to Lori, the rest of the team at PacWest. We've been working with you guys for years, putting on these events when we were doing them in person all over the country.
Yeah.
PacWest was a key partner, so it's great having you join us here in the virtual digital environment.
Yeah.
Next up is Carl Eppers with TriNet. Carl.
Hey team, how are you? Carl from TriNet here. We provide a fantastic back office HR solution and benefits, but this event is certainly less about TriNet as it is about our fantastic speaker that we have here. I was supposed to connect with you yesterday. Sorry I missed you, but I recall Elsie. But you know, the folks at Early Growth just always do a fantastic job. We got an incredible group of partners here, so everybody's in for a treat here because you guys always do a really nice job. So much props to the speakers and the partners that we have in this room. Thanks,
Carl. TriNet's a regular partner of ours in putting on these events. They've been a regular partner of mine. I mean, as I go back to my entrepreneurial roots, when I started a business, the first 2 phone calls were to TriNet and to Early Growth. It's like, let me get my HR and get my finance in place so that I can start focusing on my business. So thanks for joining us again today, Carl. Next up is Alejandro Alvarez with Cushman Wakefield.
Hi, everyone. Good afternoon. Happy to be here, and thanks to all our partners and to Early Growth for continuing to put some great events together. I will say, though, I'm looking forward to getting together in person, hopefully in a few months, and continuing to do these. But anyways, for those that don't know me yet, you know, my team and I are part of the technology practice here at Cushman Wakefield. And because of that, you know, we do focus on advising high growth startups and technology companies. And that involves everything from, you know, a 10-person seed stage group looking for options in, you know, WeWork type providers to, you know, large headquarter relocations for several thousand employees. And that's not limited just to New York City, where I'm based. We do work across the country and abroad. So we really look at ourselves as long-term partners to our clients in order to really proactively engage them in how they manage their real estate and how they plan for growth. And frankly, you know, obviously a lot of our clients are still in this early process of getting their employees back to the office and really evaluating what, you know, the new normal looks like, how their footprint changes. So we've played part in a lot of those discussions with our workplace strategies teams, our incentives teams. And, you know, we're in a unique period in time because, you know, the down market is providing some great opportunities for our clients that are ready to make decisions now. And that involves everything from flexible providers to long-term leases and really working together across different markets to provide a valuable, flexible, and cost-effective solution. So to everybody that's listening, as you guys really evaluate kind of what that future looks for your firm, again, whether you're 10 people or 120,000 people, happy to have a conversation, happy to talk to you about what we're seeing. And yeah, we're here to be a resource.
Awesome, Alejandro, thanks so much. Your lips to God's ears. Can't wait till we're back in the office again. Yeah.
Fingers crossed.
We're coming soon. Next up, Zach with Lighter Capital.
Hey everybody, this is Zach from Lighter Capital. Just right off the bat, I want to thank Early Growth for having us and Dan for including us. Had a great relationship, and these events they put together are always excellent. So really excited for today's session. But real quickly, Lighter Capital, we're an early stage non-bank lender, mostly to technology and SaaS businesses. We provide anywhere from $50K up to $3 million in growth capital, usually in a 3-year structure. You know, we lend against MRR, so kind of a different flavor than your traditional factoring or lines of credit or other sorts of products. So really want to, again, thank Early Growth for having us. These have been wonderful events.
Thanks, Zach. Thanks for all your help. Non-dilutive capital. Wow, magic to my ears as a founder. Really a great resource and a great option if you've got a company that has recurring revenue. So thanks again, Zach. We're going to kick back off. I'm going to share my screen again real quickly. We have one other partner, and I'm going to ask Phil because I don't see Mike Burson on the attendees. So Phil, do you want to give a short intro to Chainstarters, our last partner?
Sure. Chainstarters is more as a platform as a service. They have built a 60 to 70% kind of back end of every mobile app development. So really their goal is to be that predictable software development cost as you are going and building onto your different mobile applications, whether you're working with a front end outsourced team or you're trying to build it within house. They try to provide the infrastructure to build upon.
Awesome. Thanks. Okay. So just quickly before we move on, we're done with all the preliminary stuff. We have a promotion running. January rolls around. Start thinking about your taxes now. Don't wait until April 15th to get your taxes sorted as a company. And we put together a small promo to help you do that. We've got thousands of tax clients. We have a really, really amazing tax practice, and it's an unbelievable screaming bargain of a deal. And then you get $500 off of that. So it's really cool. Check it out. earlygrowth.com/tax promo. We're going to just quickly here take a poll to see who's in the room while I reintroduce Phil Rader, who's going to be your host today. So Phil's our East Coast lead based out of New York City. He's been with us for 2 years and a key part of the team. And Phil, I'm going to kick it over to you, and you can introduce your co-moderator and then introduce our special guest today.
Sure. Well, thank you for the overview. Phil Rader here. Love working with early growth, came from the PE world prior and absolutely fell in love with this ecosystem, and I'm here for life. But truly introducing Ellie and Fenwick as our co-moderator today, and I'll let Ellie give a little background on himself, kind of walking through on their practice and his area of focus.
Sure, thanks, Phil. Hi, Lee Curie from Fenwick West. We're one of the 3 premier Silicon Valley-based law firms. We represent early-stage companies, late-stage companies. You know, we formed Airbnb, we formed Apple, we formed GitHub, but then, you know, we represent companies all the way through the life cycle. We did Facebook's IPO, we did GitHub's M&A sale to Microsoft for $7 billion. We do a lot of, we're also life science, probably 30% biotech and life science, 70% tech. Mostly company focused, probably only 20% investors. We represent some of the big investors like Sequoia and Lightspeed, but mostly try to represent the tech companies. I myself am in the New York office. We're based in Mountain View, California, San Francisco office, Seattle, New York, and a brand new office in Santa Monica. I do early stage, mid stage. Just one of my clients just went public 2 weeks ago. So I did my first IPO. I actually was a partner at a different firm, went in-house to a tech company, was in the Edtech space. It was an enterprise SaaS platform for the digital publishers. And we sold to Francisco Partners, a big private equity fund. I took a year off and I'm actually back at Fenwick, and it's one of the greatest places to work. Love working with early stage companies, love learning about businesses, because after being an entrepreneur, you know, a general counsel and COO at a tech company, I really, really get interested in working with founders, and it's my favorite part of my day.
Awesome. Ellie, it's great having you today. Phil, you want to introduce our guest star? You're on mute.
Sorry. So today we have OVO Fund and our guest Ilse Calderon. Give a little bit more about their fund. She's a principal. Their pre-seed fund, about operating out of a $35 million fund, really focuses on being the first check in, incubates and backs early stage startups, going from a 250 to about 500K check, and reserving obviously more follow-ons prior to the Series A. But I'll let her give a little bit more background on herself as she kind of introduces, and we'll go kick off the event.
Thank you. Thank you for the introduction, Phil. Like he said, I'm currently working at a super early stage fund. I saw the poll and noticed that about half of you guys were looking to raise a seed round. Happy to talk more about that a little bit later. But essentially for us, we want to be involved super early. And I mean, truth be told, that is the scariest stage, but in my opinion, it's also the most impactful and really the one where you get to be involved with founders on a really deep level. But yeah, we invest 250K to 500K, and then we'll reserve some for follow-on, and that's across most capital efficient sectors. So about 1/3 of the portfolio is e-commerce consumer startups, and then the other 2/3 is smart enterprise, and that's across the US, mostly in the Bay Area, but nowadays Bay Area transplants are everywhere, and there's great founders all across the US. So we've kind of gone a little bit in that direction as well. But thank you for having me.
Great to have you as well. And I guess digging a little bit more in as, kind of walking through these different labels and stages and everything that goes on with the capital raise. Then if you give a little more color on kind of just when you first start engaging with conversations, if there's any traction or what traction, what really, founding team, what really kind of draws you into that, and then kind of the type of valuations you'd be looking at for a company for a first investment.
Yeah, that's a good point. I think at the end of the day, the answer is it depends. But to give you a little bit more color on that, it depends mostly on sector and team. Sometimes you're in a sector where it really doesn't make sense to raise a little bit of funding. And so like your first round of capital probably has to be like a bigger 3 to 4 million. And that's like the first time you really raise institutional. And that's mostly for sectors that you kind of need to hire a couple of engineers. And so if you raise $1 million or less, that's really going to get you like, I don't know, maybe 2 Bay Area engineers. But then there's other sectors that you can do more with less. And so for us, we prefer to be in that sort of maybe sub $1 million round that you go off and raise. And then, maybe that gets you a year and a half, ideally. And then you're at a point where you have done significant progress on your business where you can go on and raise your next round. But I think the nomenclature is a little meaningless in terms of like pre-seed, seed, because it's more important sort of where in your startup journey you are. And I think a way to look at that is to just think about like what milestones you need to accomplish in order to be in the next level of your business. And then you can kind of like go backwards from there to determine how much you want to raise and what makes sense.
Completely understand. And it's all part of the process. And obviously you're a key factor being in that stage for those specific type of founders and industries. And
Yeah.
I guess before you give us a little more background on you, your career, what kind of led you to this role? What excited you to come and join OVO?
Yeah, Phil, that's a good question. To me, well, I guess I'll give you a little bit of background on myself. I graduated from Stanford in 2016, and from there, I went on to do a recent grad rotational program at Silicon Valley Bank, which, it's in the Bay Area. I'm sure you guys, because of the space you're in, have heard about them and maybe even work with them. But really, the program that I did there was focused on recent grads. And so I myself rotated across different teams across hardware, consumer, mobile. And, the idea with that program was that you'll eventually land in your home team about like a year and a half later. But I actually didn't get to that point because I left 10 months in, a little under a year, because don't get me wrong, I love the people. I actually ended up being roommates with some of the people there in San Francisco afterwards. But it was just very formulaic in my opinion. And when I was in college, I had done an internship at another early stage venture fund. And that was sort of my first experience and stint into, this is what the venture ecosystem is, even though I really do think each role within venture is really different, and associate at one fund can mean something totally different than at another fund. But even though that was the case, I really did want to be more involved on the equity side. Of course, it was more risky in terms of like the work that you're doing, but I also thought it was more rewarding. And so for me and how I landed at OVO, and let me just caveat with saying that like OVO is a really small fund. It's 2 people full-time. So apart from the partner, Eric, it's really just me on the full-time side of things. We do have a third partner and, our pool of advisors and partners and entrepreneur in residence and so on. But on the full-time side of things, it's just Eric and myself. And so when I was looking to make my step into venture, one of the things that I really was looking forward is being able to be in a role that I was able to have a lot of responsibilities and, sort of grow within the role and really bring on initiatives that I thought made sense because of, what the fund was investing in. And then the other thing that was important to me was that it be super, super early stage. And so I connected with the partner, now my boss at OVO, and, we chatted, one thing led to the next, and that's how I ended up there. I do think that most roles in VC are super, well, like the recruiting process is really not transparent at all and really weird in the sense that, it just varies. It's a super nonlinear path. It's not like, banking or consulting where the interview and recruiting process is sort of like the same across. And so for me, like one of the most important things was also the mentorship and who I was going to be working with, which was Eric, and making sure that, our goals were aligned in the sense of like what my career growth looked like and, being able to sort of lean on him to learn a lot of the parts of venture because it really is very much like an apprenticeship style business.
No, and I think it's important to understand too for these founders that they're reaching out to different style funds, not only with the fund sizes, with the check sizes, the industries they're focusing on, but also I wanted to hand it over a little bit to Ellie to kind of dig into the difference on kind of how maybe your smaller team process investment decisions are made versus, a more larger established fund that's maybe working with a, multi-hundreds of millions or $1 billion under AUM.
Yeah, that's a great question. Well, I mean, how do you find all these little companies, right? Because there's just so many little ones. Some of them don't even have websites yet. Some of them don't even have any angel investors because you're the first investor, so you're not really getting calls from the existing people on the board or the existing investors. How do you find the majority of your tech companies, or how do they find you?
Yeah, that's a really good question. And most of it is driven by network and by founder ecosystems that we're close with. I think for me, the best time to meet a founder is when they're, Google, Facebook, whatever tech company, tinkering on the side, trying to build enough conviction in a space and, the problem they're going after before they actually become a business. So in that way, you're right, it's a little tricky because it's not like they have their websites or, they're not blasting on LinkedIn or, some other source that they have started this thing. And chances are by the time they do that, it's almost too late for us because we're such early stage investors. And so, yeah, a lot of it just goes back to network and, staying close within founder communities that we think are really interesting and care about. And that's actually like one of the things that I've been striving to do more since joining the fund is expand our network of founder ecosystems. I think it works and it's interesting because more likely than not, a great quality founder will know other great quality founders. And I think staying top of mind for those founders is really important. And so, like, with that being said, it's also really important that we build those relationships with those founders beforehand. And I think, we try to get really involved to the extent that like the founder wants it and it makes sense in the brainstorming and like the company formation phase, even pre-investment. And it's also a really good way to sort of like track progress and sort of like plot data points of the progress that the founder is making so that, when they get to a point where they have enough conviction in the business, they sort of, have this couple of hypotheses that they want to go test out. And so they want to raise funding for, then we're sort of there at that point.
Yep. So, your early stage, you're usually the lead investor, but I can't imagine the diligence process is super deep on an early stage company. But, one of the things you said, which is, really good advice. And I tell my startups this all the time. I say, when you're raising money, talk to the investors early. Tell them this is what I'm planning to do. You can get validation on those proof points, or they can say, well, no, you shouldn't be doing that. You should be doing this. And it's a good conversation. You'll learn from everyone you talk to. And then when you call them back up, when they call you back up 6 months from now, they can say, hey, remember those 3 things I told you I was going to do? I did them. And that proves to you, right? But in your diligence process, what does it look like? What are the things that make you excited? What are the things that make you say, this is the company that we're going to invest
Yeah.
in?
Yeah, that's a really good point. I think at the top of the stuff that we look for is founder market fit. And we sort of define that as, does the market that this founder is going after, is he super excited about that space and really passionate about it? But also, realistically speaking, does his skill set blend in nicely with the problem that they're going after? And that's probably like the North Star that we're looking for that really needs to be there. But then apart from that, there's other stuff. So I really want a founder to have a strong point of view on the sector and where it's going. Now, that point of view doesn't have to be the same as mine. Like directionally speaking and like long-term vision, yeah, we need to align there. But like I'd rather see a founder that really believes a sector is going in a specific way than just kind of like saying stuff that everyone else is saying. And then alongside that, I want them to have unique insights that they have found in that space. And hopefully those insights are part of what's going to help them build defensibility in the space that they're going after. So for example, we recently invested in this company that they're in the fintech space, but they're really going after a highly antiquated old school player, which is pawn shops. Pawn shops is actually a really interesting market, but it's also one that like you don't hear about often because it's really old school, right? And especially like in venture, you don't hear about it often. But the reason we made this investment was one, because the founder was like, it's crazy how excited he was about pawn shops and their business models and really where they make money, which is on their loan products and their debt products. And so that's what got us excited about that specific founder, and the fact that he had also spent like the last year or so working on a pawn shop to really figure out the ins and outs of that business. And he's probably like top 1% expert in this space. And to me, that's really exciting. And then like the market also made sense, but the primary thing was the founder market fit and the excitement that the founder had for this.
And do those markets have to be, do you need a unicorn status? I mean, the market has to be $1 billion to go after it. Like a shout out to Lighter Capital, they look for, software companies with recurring revenue. And, as long as they have cash flow, they can take this investment, pay it back and grow. Whereas, you're looking for not just somebody that's going to pay you back and have cash to do that, but actually is going to burn the cash to get big enough for this investment to be, the next unicorn. Is that your model, like the typical VC?
I mean, absolutely. At the end of the day, it's a venture fund, and like, not to sound cheesy, but we have to believe that it's going to become $1 billion opportunity. And like, what's the path, right? Like when we make investments, we have to believe that that team and that founder in that market can grow to be a really, really big business. Sometimes, we make the investment, stuff happens, and along the way, hey, wait, we actually realize that it's a $500 million business, right? And then we adjust. But if we begin with the assumption that that's a $500 million business, chances are it's smaller than that.
Right. And you say, and what's the path to get there? Have those paths changed over the last 12 months? And I'm sure, if I asked you this question in April, you would have given a different question than you would in October, than you're giving it in January. But, how does your investment focus? How do the kind of companies that are exciting to you, the prospects of an investment being successful, what are you looking for these days that might be different than you were looking at pre-COVID or in April?
Yeah, that's a good point. I think nowadays we look at everything with sort of like a post-COVID-19 lens. And that really means like, does this business make sense in a post-COVID world? Now, I do believe that there are some trends that are stickier than others. For example, one really hot space is digital health. And, even in post-COVID times when we're going back to the office and sort of being more normal, I still think there's going to be some trends of that stick around and really accelerate the business. So that would be an interesting one. But then there's also some sort of like second order orders of magnitude that like have been affected by COVID that are interesting to look at. So one of those, in my opinion, is Edtech and, you know, what COVID-19 has done for distance learning. And so because of that, post-COVID, we made an investment in this company that is really going after teaching children a second language in a sort of distance model. And that has traditionally had its own sets of challenges because, you know, they're going after children that it's really hard to like get them to stare at a Zoom call for like more than like 10 minutes. And so, you know, they have like a 3-prong approach that we think will make sense with this audience. But this company is interesting partly because of what's going on in the world and the way people and children in K-12 educations are learning now. Yeah.
So we spent a lot of time talking about what you're looking for, you know, why you would invest in a company. Why would a startup want to work with you? You know, what value do you bring? What kind of resources does an early investor like you really bring to a company that's only raising $500,000 or $1 million?
Yeah, I think that's a really important question.
And how would you be different from another resource that,
Yeah.
you know, is not just another pre-seed investor, but, you know, some of these accelerators or something like that? And I know that, you know, they're not mutually exclusive. Some of your companies may go into an accelerator, but why would they come to you first or to you as opposed to a different seed investor?
Yeah, I think that's a really important question because it's a mutual process. Like throughout the due diligence process, we're not just interviewing them and getting to know them, but the opposite is also equally important. And like we actually encourage founders that we're talking to talk to some of our portfolio companies so that they can learn from like their experience, how we work with them. And it's always on a case-by-case basis because half of our founders are first-time founders and they are a little bit different in terms of like how we can best help them compared to more serial entrepreneurs. But it primarily falls under 3 buckets. So one is around fundraising. And this is probably where we spend around 50% of our value add time. And, you know, it's kind of our job to make sure this company is well capitalized until they get to that next round of funding. So for us, that really means helping them with everything from like pitch assist to the right interest to the right co-investors, either within that round that we're also participating in or in the next round. So earlier you alluded to a point that you also tell founders, you know, talk to investors early so that you know what they're looking for. And that's something that we also emphasize because, you know, we think we want to be close, not just to like our community of co-investors that are also early like us, but to the next round of investors, which I would consider like the more traditional seed investors, because it's important that like our founders know what that level of investor is going to be looking for in terms of metrics and traction for these investments to then be interesting to them. So that's one of the areas where we help them in. Another is around customer development. And this is different than intros to customers because quite frankly, our companies are too early for, you know, the Sprints or T-Mobiles or whatever big company of the world to be their customer. We're mostly introducing them to customer development partners that understand that the tech and the status of the company is still very much a work in progress. And more than anything, they're willing to give them, you know, feedback and really want to test something that's neo and novel and not really fully fledged out there. And so that type of customer is different, right, than the one that is already ready to pay up for like a product that is completely ready. So that's the second piece. And then the third piece is around recruiting. Although this is sort of like a hit or miss because it just depends on like where our network lies and like what type of role and person they're looking for. But the one thing that is important to know is that within that world of recruiting, it's like the first 2 to 5th, maybe 2 to 10th employee that a founder hires is going to be highly motivated by the founder and wanting to work with him or her because, you know, it's kind of like you're asking someone to take a massive cut from like a salary they could be making anywhere else to come work with you where the percent of upside is really small. And even if it works, like you are not like, you don't have the same level of like equity as the founder. So that's tricky. And so we help with that because like, I really think that employee number 2 to 10 is very different than like someone that is used to and likes working at like a company with like hundreds and hundreds of software engineers, for example.
And with that, you mentioned as to primarily the breakdown of your investments into single founders. Do you prefer they have co-founders? Are you helping them with that so when you said the 1 to 2 to 10, I'm trying to understand kind of at your early stage what the current team looks like, or maybe there's advisors that are going to be coming on.
It depends. We kind of have it all within our portfolio. We have single founders, we have co-founders, and if I'm saying what we prefer, we do prefer co-founders because building a business is really difficult, not just for like the execution piece, but for like the mental piece and like the stress and everything that comes alongside. And we do think having sort of like a partner in crime to go with you through that journey is important. But that being said, the wrong co-founder can break the company. So we'd rather invest in like solo founders than like 2 co-founders where like things just don't add up and it's not like the best combination. So we kind of do it all. And in those cases where they are solo founders, we do end up playing a heavier role, just not just as their like sort of cheerleader, but it really depends, just like talking through them with anything that they need help with. And, sometimes we end up having conversations with them that look more like co-founder conversations than like founder investor conversations. And like sometimes it's just like providing a bouncing board of ideas and brainstorming. Yeah, but I wouldn't say we prefer solo founders. It just, we're not gonna say no to a solo founder just because they're a solo founder.
One of the questions from the audience says, could you share how you see the VC landscape for female founders or for diverse founders? I mean, you and I are both children of immigrants from Latin America. There's not a lot of people that look like us in the venture world. It's getting better. Fenwick actually just made the largest partner class 14, and there was a lot of women and people of color. And but you look at the people who had been partners 10 years ago, and it was all the same. And America is not all the same. The consumers of people's products are not all the same. Being able to tap into how people think is not all the same. So I think having diversity of opinions is always great. But how do you see that when you're looking at founders, whether women or people of diverse backgrounds? And I know Early Growth has a great program to support African-American founders. But from your perspective, what do you think the landscape looks like and how is it changing?
Yeah, there's definitely, especially in 2020 and now, a lot of conversation about that. But I think sometimes what happens is that the conversation doesn't really turn into action. It just kind of lives in, the world of Twitter or, whatever social media you follow. And it's highly important. It really is. One thing that you mentioned that I want to touch on is this fact that the US prides itself in being a melting pot of many different cultures and traditions and type of people. And when most of the people building the next generation of companies all look the same, then that's not really representative of the population of the United States. And that kind of like blends itself a little bit into like my thesis and why I think it's important. And it's sort of like the rise of the hyperculture Latinx, which really represents this 20% of the US population that is a big spender and a big consumer of services and products. But a lot of these products and services aren't really solving their needs and don't really get them. And so because of that, they don't come off as authentic. And so I think that's like a big white space that investors and founders are missing out on. And I think part of the reason is because most founders that get venture backed all look the same. They're typically white men that come from your top 3 universities in the US and so. And and so like for me, it's really important that I sort of like do my part in like expanding that world of founders that we look at beyond what is traditionally known, especially in Silicon Valley. And we do have like a couple initiatives around that. I think it's really cool to get them involved anywhere from like the college student level to recent grad, and even like when they're mid in their career. I think especially as it relates to Hispanics, we are very entrepreneurial, and there is a lot of really interesting momentum there, but the opportunities that that community of people has is not the same. And so because of that, we don't see a lot of like venture backed founders that come from those backgrounds. Yeah.
Interesting. And going to the other questions we have within here, I know you mentioned kind of your smart enterprise and the valuations. And I know Mike asked a little bit, AI software, particularly going after oil and gas. They're raising $1 million round, which you're a part of. Kind of how do you look at kind of that valuation of that? How do you really kind of dig into it? And I guess the next piece is kind of going to Alan's question. As you're doing that, how do you really, or how are you justifying or proving to that, I guess, the product market fit going into it? So I know it's a lot founding team and then the product going into that market.
Yeah. I would say product market fit is after we invest. Like 99% of the companies that we invest in are pre-product market fit. Product market fit is sort of like their goal with that round. Like we want companies in the smart enterprise space that can get to product market fit, or at least strong signals of product market fit within $2 million of funding or less across different rounds. But yeah, like in the smart enterprise world, what we really look for is when we invest, the companies usually have like a pilot or two with, a couple enterprise customers and a couple hypotheses that they want to test around that. And the goal is that with this round of funding, they will be able to, essentially the goal is, how can I get this customer to be really, really happy, right? Because then that's powerful. And then they can be like a source of referral. And once you have one happy customer, it's a lot easier to go to a second than to go from 0 to 1. Most of our investments are in that world of AI, ML applications into vertical industries like construction, trucking, real estate, fintech, and really this more traditional, stodgier, the less sexy industries. That's kind of what we call them. But like at the end of the day, the thing that is at the epicenter of that is the founding team and what they're doing different in that space.
Amazing. And it's good. Working off of that, as they're getting to you, you're going through all of this, and you talked about people reaching you. It's a lot through founder networks, first-time founders. If you don't have that network built up, you're newer to the ecosystem. What do you see as tactics to advise founders to be able to start embedding themselves in the circles they need to be in to start opening these doors?
Yeah, I think in that way, it's not impossible, but you do have to be a lot more proactive about it. And, you hear the stories of founders that went out and like talked to 100 or so investors to be able to raise like their $1 million pre-seed. And because of that, I think one of the more important skills to have as a founder is resilience, and understand that you're going to get a whole bunch of no's before you get a yes. And in a way, I do kind of think it's a numbers game, right? And how many investors you talk to. And like, we see investments get funding that we passed on all the time, and the vice versa is also true. And I think that just speaks to the fact that there's all this capital out there. And so you kind of just have to find the investors that align with what you're building. Obviously, there's also like the whole question of like, make sure you're building a venture backable business, which not every business is, and that's perfectly fine if it's not. It just means you need to go into a world of like alternative sources of funding. I'm not sure if I actually answered your question, but I went on a tangent there.
So any advice on that fit? Companies that you pass on that other people invest in, or vice versa. When some of the founders are talking to 100 investors, hopefully they're not doing the exact same pitch to all 100 investors. So when they come talk to you, What kind of research do they do about you? And how should they change their pitch to talk to you as opposed to another similar fund?
Yeah, I think there's so much information available in the internet nowadays that, when you come into a conversation with an investor, I think it does put you in sort of a stepping stone if you have done your research on the fund and the investor. So one of the questions that we always ask is, what do you look for in an ideal investor? And the reason I ask that is because I want to know that, if we make that investment, we can be helpful to that founder, because we don't want to be just like money, right? Because chances are for those strong founders, that money's going to be there. And so it's really important that we know that there's a way that we can help them. And so to your question of, what they can do, I think it's one, we try really hard to put all of our portfolio investments in our website, because I do think it's important for founders to look at that and see what we have invested in that's either in the sector they're going after, as well as, it kind of shows how we think about things and, where we're willing to sort of put our money where our mouth is by making those investments. Yeah.
Understood. And I guess going a little bit into the overall flow of capital before it hits this pre-seed founder. And someone was asking global recession, what if the LPs aren't coming in? Because I think it's good for all these founders to understand that you fundraise too.
Yeah, there's some point in time where we also are founders, and we have investors, which is funny to think about. Yeah.
So yeah, I guess when you have your thesis, you have your things, your strict things you're sticking to, whether it's the right investment for you or another investor. I think it's just important for, if you want to address a little bit more about kind of how that cycle of capital kind of trickles down to them.
Yeah. Just before I start that, I think one interesting thing is 2020 was an awesome year for late stage investors, right? I mean, look at all the IPOs. You guys work in that space, so you know. And so what that really means as it relates to funds and limited partners, which are our investors, is that chances are they're going to be looking to reinvest that capital, whether that's in direct investments in founders or in more traditional venture funds. I think 2021 is going to be really interesting for that. And so, the way we work is, this is our second fund. So this fund closed about 3 years ago, which is when I joined. So I wasn't involved in the fundraising of the first fund. I kind of came when all the capital was there and, we were looking to deploy it. But now going into next year, that's going to be something that we have to think about as it relates to raising a third fund. And we also have limited partners, but all of our limited partners are either high net worth individuals or family offices, so non-institutional money. And one thing that we try to do really hard is stay up to date with them and do our quarterly reporting and make it as easy as possible for them to track our progress. So when those conversations come, it's faster and we have done sort of all our work so that it doesn't take an infinite amount of time to get that going. But usually the life cycle, or you have 4 years, maybe 5 to deploy the capital, and then you'll start having conversations around what does the next round look like. Chances are you'll have the conversation before it actually needs to happen, but that's kind of how it works. Mm-hmm.
Understood. And I guess that's one side of things. And looking at kind of your split and looking at, you have these mostly B2B, smart enterprise companies. And then how does that metrics, traction, founding team, everything else differ from kind of the more consumer e-commerce side that you mentioned beforehand? Because I think it's important to distinguish these different type of founders. And then last piece to that is, do you have a reluctance towards hardware? If there is towards that, yeah.
Yeah. So I'll start with the second piece. The reluctance to hardware. I mean, yeah, nowadays you see less funds doing hardware. And those that do are probably more hardware specific funds or really big funds that just do everything. The reason that we don't really do a lot of hardware is because it does tend to be more capital intense. And so I kind of like earlier alluded to the point that we want our founders to be able to get to product market fit with 2 million. If you're building a hardware business, that is more difficult, but I do know funds that like just focus on hardware. And that being said, we do have a few hardware investments. And that's because it goes back to founding team and, you know, who we have relationships with. And, you know, sometimes it happens where you invest in a company and at the point of investment, it looked more capital efficient, but then the founder pivots and they really become passionate about something that's more hardware intense. And, you know, at that point, you're not going to abandon your company. You're going to keep being supportive if, you know, they keep making progress and their execution is there and everything else kind of lines up. And so we end up with like hardware companies. Like we have an investment in a autonomous vehicle company, which is very capital intense. So it just kind of depends. But, you know, we do say for the most part, capital efficient. But I think in venture, you're sort of in this business of exceptions. And that also applies to hardware investments.
Gotcha. And then towards
and then your first, what was your first question? Sorry.
First piece was just towards the different founding teams, traction metrics you look for on the kind of consumer e-commerce side versus the B2B smart enterprise side.
Yeah. Well, when we make investments on the smart enterprise side, kind of to what I was saying, those companies are like, in most of those companies, I think putting together a team is a milestone in itself, especially for companies that need like developers, right, to build a product. And that's a milestone that is significant, right? Bringing that team together, especially when it's super early stage. And so for those companies, it's also where you have like a couple, maybe one or two customer development partners. And those also are more time consuming to get than the consumer side of things. So that's sort of where we want the company to be. In that world, you know, sometimes we will take like customer calls before we make an investment to figure out what the customer is excited about the product. And then on the world of consumer, I think for the most part, you can get more done with less. And so we kind of do expect companies to have a little bit more done in that way. The other thing that I think has been amplified by 2020 is that, you know, previously we used to tell, especially consumer companies, to be like focused on growth. But I think that mindset has kind of changed. And like, even for us, we are more concerned than previously with profitability and being able to get to that milestone. And then obviously like capital to grow later on. But, you know, sometimes certain sectors of consumer are less venture capital friendly. And so we want the companies to be in a good position to grow and also think about alternative sources of funding past venture. I think one interesting trend going on in consumer is also a bunch of like roll up aggregator strategies. And that kind of starts to look more like private equity, but I think they are examples of like venture investments in that world. And the more of that we see, I think the more movement we'll have in that.
Understood. And I guess kind of circling back to the initial question we had was around just the overall for stage you're coming in, giving a little peer, and I know it all depends. There's always exceptions. But kind of that range of valuations, like pre-money, post-money, kind of what you're following into for at these very early stages these companies are at.
Yeah. So the valuation is, for the most part, anywhere from like 3 to 8 million post. We have done, you know, all the way up to 16, maybe even 20. But those are usually, we definitely don't lead those. And, you know, we'll just pile on or co-lead or just be an investor in a round where a larger investor has the lead position. And we end up doing about half and half leading the investments, half piling on.
And the structure of that is all in safes. mostly, right?
Yeah,
Or convertible
saves,
notes?
99% saves, convertible notes. It's definitely too early for the most part for priced rounds.
And do you have advice for founders who are setting up their company, taking maybe a little bit of money from friends and family before they come talk to you, how they should structure that? I mean, should they be selling common stock to their friends and family, or is that sort of a no-no and sort of prevent them from doing certain things, and they should be doing those on safes and convertible notes as well?
I think they should keep it as simple as possible. The tool that's probably that is just the typical YC safe, post money, no discount. That's what we see a lot of founders do at sort of like the angel round stage. And that feels like what works out the most. But I would say, yeah, don't like at that stage, it can be fairly simple. And so don't overcomplicate it with like fancy terms or some other formats that you prefer. And then the other thing is also try to give, if you're investing within the same time, if your angels are, try to give them the same terms to keep it cleaner. But that being said, it can get messy if you have like 100 investors, sorry, not investors, angel investors that are investing like 1,000 each, right? Obviously everyone has different scenarios and everyone has different like personal situations that allow them to raise from who. Like I've seen like $1 million family and friends rounds, and like that isn't feasible for a bunch of founders either.
Do you have any opinions on crowdfunding? And if a company did crowdfunding before they came to you, whether that makes it more difficult for you to invest?
I would say with crowdfunding, well, I think it's really interesting and necessary to sort of open up the world of like private investments to other investors outside of like your traditional venture investors. So I think that's one really awesome thing that, places like Republic have done really well. We haven't invested in a company that came through crowdfunding or that raised the crowdfunding campaign previously, but we definitely have talked about it with our founders after we invest, like when they're maybe going to raise their next round. And I think it mostly makes sense if it's also going to be a great way to build publicity around what your company is doing. And so because of that, most of the companies that I've seen have success around that are more consumer facing, because it's basically a world where you're having your consumers, your customers buy into your company. And I mean, there's like plenty of really good examples that do that.
Mm-hmm. So sort of like a Kickstarter, but instead of pre-selling your product, you're saying, hey, you can own a piece of this cool new brand, and just to make brand awareness. So you're basically, people are paying you to do advertising.
Yeah. I mean, but you do have to commit like the time and resources to put together that crowdfunding video and like the requirements, right? Like that's non-trivial, but yeah, it could help.
And I know we are reaching the end of the hour. I'm happy to stay on and do more questions. I first wanted to thank you and OVO for participating in this, Ilse, and wanted to kind of ping Dan Data, see if there's anything top of mind as we've been running through this, and that you wanted to ask of Ilse.
Thanks, Phil. Yeah, just a quick thank you to all our partners and all our attendees. We are going to stay on for a few minutes. We're going to go into overtime. Overtime's really exciting. This is when all the good questions happen, so hang in there. But I did want to thank all the attendees and all our partners. We do have another Meet the VC scheduled for February 10th with Josh Mittler from Upfront Ventures here in Los Angeles. So go to our website and sign up for that one now, but we'll be emailing you. As you could expect, we'll be emailing you. Ilse, I did have one question for you to kick off overtime. Geography. There was a question in the Q&A about moving to Miami. And if you're in the Twitterverse, you see a lot of talk about how entrepreneurs and investors are migrating to places like Miami and Austin. But for our audience that's located nationally here, I think geography's changed a little bit in the pandemic world. And maybe you can talk a little bit about how Palo Alto-based OVO fund thinks about geography, and how you're not in Palo Alto right now, how you might think about geography as well.
Yeah. Yeah, it's crazy because, you know, when I talk to founders, I'm like, oh yeah, we are based in Palo Alto, Bay Area fund, but I really haven't been there full time since March of last year. I left right when California went into lockdown. And so that's a really interesting question, because I think it's also definitely happening on the founder side. And with super early stage, I do think we miss out on something by being purely Zoom, because there's just some mostly soft skills, qualitative elements of founders that we don't get from this Zoom calls. But that being said, I think like we understand like we need to adjust to the reality. And pre-COVID, most of our investments were 85% were Bay Area, because we did believe that, you know, being able to be close to the founder allowed us to be more helpful. And then the other founders were in LA and New York, and we would travel to those geographies quite often. But, you know, in a world where everything is via Zoom, that matters way less. Like we recently made an investment in a Pittsburgh-based company, and that's something that we might have not been super interested in pre-COVID, right? We might have been more tied to, oh, but they're in Pittsburgh, how can we help? And so I do think that's one good thing that's come out of COVID, just expanding where founders are that we're investing in.
And how do you meet them?
Exactly, yeah.
Right?
But that being, sorry,
were you
what?
the kind of fund before COVID where you actually had to physically meet the founder before you would invest?
Yeah, I mean, it was never a rule, but it always happened. You know, like kind of like the way our pipeline work is we would do screening calls, and then if those were interesting, then move them to face-to-face meetings. And, you know, we would go to New York every quarter, LA every month, and so on. But like even those companies, we also invested in a Cleveland-based company, but like even those companies that we've invested in outside of like the three common geographies, I think the one thing that they have in common is their networks are still based for the most part in the Bay Area, right? And so we find out about them because they're either a Bay Area transplant themselves that moved to Pittsburgh, you know, some other region in the US, or we know someone that knows them. So that relationship piece still very much applies. If anything, it's more important because we, you know, have certain people that we really trust. And so if they introduce us to a founder, even if they're in Pittsburgh or Cleveland, then, you know, they sort of pass that first filter. Yeah. But I think we are going to see more and more of that this year. At least for the first half of this year, I'm kind of operating under the assumption that we won't meet founders in person.
Understood. And I guess that kind of goes to, for how early you are, you said someone you trust in the ecosystem. I mean, it could be Ellie, because he's really probably forming the company as they're talking to you at this simultaneous time. And really, do you invest not only pre-revenue, but pre-MVP, because it is the founder who has the idea? I assume with how early you are, they haven't quite built the product yet. So it's a question on that. And then two, just kind of beyond just this ecosystem relationship and founders, kind of where other sources you prefer to get deal flow from trusted resources.
Yeah. So the first part of the question, sorry, what was the first part?
The first part, do you go pre-MVP, which I believe is yes. Correct.
Oh, yeah. Yeah, we do. We invest idea stage the earliest. You know, earlier in our description, there was a part that said we incubated companies. And so that's kind of tied more to that idea phase. And especially as it relates to technical founders, we do have an initiative around super early founders. And so like, it's not even the pre-seed stage, but it's sort of like this proof of concept stage. And so with that, we mostly look for PhDs, postdocs, graduate students, and technical founders that have this domain of expertise that they're experts in, but they don't necessarily know like what the best business application or use case for their technology is. So we invest in those companies, and in that way, they're earlier than pre-seed. We call it proof of concept, even though that's probably not the right name.
Understood. Yeah, and I guess that's the next piece is just anything on how you're looking for deal flow and how people can continuously leverage their networks to open more doors towards an investment.
Yeah, I think, in terms of deal flow, I'm always looking to expand that, especially as it relates to communities of founders that we are not already tapped into. And this kind of goes into what you were saying earlier of, how do we look for founders that are diverse and maybe don't have the ecosystems and the relationships with investors already. And I think like we always need to be expanding that. And like the best way to for founders to reach me is by sources of referral. Like, if there's a founder that we both have in common that we know, that's definitely better. But that being said, I wouldn't discourage just like a cold outreach if like you don't have like that mutual connection that can help. But in those emails and conversations, I think what's really important is being specific and brief.
Understood.
Sorry, there's like the dog barking in the background. That's why I'm muting myself.
No worries. I think he's telling us, come on guys, wrap it up. No. But no, it's been an absolute pleasure having you and meeting you over the last 2 days. I guess to Ellie and Jen, are there any last comments you wanted to wrap up and ask yourself before we close the event?
I'm good. I've participated in and watched a lot of panels, and this was great. They'll say you were fantastic.
Thank you, Eli. And thank you, Phil and Dan. It was great.
Thank you, everyone. Thanks for joining us. Again, please come join us again February 10th, and we'll be scheduling these monthly throughout 2021. So everyone, Happy New Year. Thank you and goodbye.
Yeah, thank you, everyone. This was wonderful, and I hope everyone has a good start to their 2021.